crucial aspect. And money market, let me tell you something, guys. Money market is one of the largest market, if I compare this market with stock or bond. So money market, in terms of size, it's a very big market in the world. Very big means very big, and highly liquid market. Highly liquid market. In terms of regulation, you might see, the only, to some extent, RBI has control, but not, fully, because RBI only responsible for monetary policies like, SLR, CRR, and to some extent, to bring some regulations around FX conversion or FX deposit, so that, borrower or creditors, investors, companies, they can follow the rules and regulation and ensure they are following everything which is required to protect to the compliance of that particular country. All right. So now let's discuss that in details. So I would like to first decode money part. Money and market. See, when we talk about money it means cash, right? Money, it means cash. So here in this money market, guys, understand this one. Anything like, anything highly liquid, that comes under the money market, except derivatives which are listed on a stock exchange. It could be like, let's say, future, forward. They are not the part of money market. So don't get confused between when we say, highly liquid, because derivatives like the exchange derivatives which are like highly liquid, but that doesn't mean the derivatives you can count under money market, right? So yeah, anyways, when we talk about money it means we're talking about cash. And when we define cash term, so cash, it means anything which is highly liquid in nature, right? And that asset class, you can call it as a money market instrument. Money market instrument. Now, if I talk about money market instruments, what are the money market instruments, right? Or who are who can participate in money market? See, first understand some technical or theoretical term, I would say, so that you can, understand the other things in details. First, RBI, is the regulatory body who decide everything in money market. So when we say decide everything, it means demand of money, supply of money, inflation, recession, even depletion, that all comes under RBI's monetary policy. And basically RBI review everything and ensure that RBI is supporting to the financial system or institution to control inflation, to control recession, and also depletion as well. Right? How? Let me put it in a simple example which you can understand it. Let's talk about money. See, money, we call it as a oxygen. In general term, we call it as a oxygen of economy. Oxygen of economy. Now, if I simply ask question, what if, let's say, what if I try to control, I'll try to control, let's say, oxygen, or let's say you're not able to take a breath because you have or you're feeling shortage of oxygen. Now my question is to you, will you survive? Come on, think for a while. If I control oxygen, will you survive? You can answer me in yes and no. Will you survive? Your answer would be no. Okay, let me tell you again, ask question other way around. Let's say there is a huge or heavy or excess of, let's say, oxygen, or the pressure of air is very high. Will you breathe? If the oxygen pressure is very high, will you breathe? Take a moment. I'll give you 30 seconds to think think on this. If let's say there is a very high pressure of oxygen, will you survive, or will you be able to take a breath? Come on, think for a while and try to answer in comment section. All right, so I'm sure your answer would be no. So it means excess of oxygen and even shortage of oxygen, both the conditions which are very critical to the human body. Am I right? So same way guys, if I talk about money, excess money supply in the country that led to the inflation, and shortage of money in the system or country, I would say, that led to the recession, right? And then who control this money supply? Who control the money supply? Who control? Who print the monies? Who print the 50 rupees, 20 rupees, 100 rupees or 10 rupees notes, or 500 for that matter? Who print, guys? Come on, who print the notes? RBI, right? So basically government of India announced tender to the RBI, then RBI print the notes and hand over that notes to the government, and then government distribute notes through their financial system mechanism. But the point here is the most important point. As I said, excess money, note down somewhere guys, excess money supply in the country led to the inflation. Shortage of money in the system again led to the recession. Then who control the money supply? Basically RBI control the money supply. RBI control. Now your question would be, sir, in India maybe let's say RBI control it, but in US, UK, in their country, who control it? In United States, Bank of America and Fed government or federal commission control it. In UK there is a Bank of England, basically Bank of England control that money, and there are many other banks as well who take care of printing, then deposit, transfer, and even the investments on behalf of governments. So basically banks take care of all the needs of a government and make sure that the bank is in a position to arrange funding for a government as well, right? So this is how you can see the role of central banks come into picture in money market. Because see, controlling of supply of money is very critical job, I would say. So let's take a couple of examples what happened, in pandemic and what is happening now. You can try to relate both the things. In pandemic, what happened? In pandemic, what happened? It was, let's say, pandemic, or you can call it as it's an emergency situation, right? Emergency situation. First, what happened in the pandemic? People lost job, industry production impacted, right? Job market disrupted, and people they were not taking any loans as such. So these were the basically the key points which you can see, right, that happened in pandemic, correct? Then what was the RBI's role in this pandemic, guys? What RBI did? RBI simply announce the rate cut, right? Rate cut, it means when RBI announced rate cut, what happened? Let's say the CRR or SLR, RBI decided to reduce, and that impacted on loan. How? Because the loan cost was cheaper. For example, let's say before the pandemic, I don't have exact data at the moment, but we can take a hypothetical situation. Let's say pre-pandemic, the interest rate cost was 10% for per annum on loan. In pandemic it means COVID. In pandemic, the bank reduced rate and it was around 9% for per annum. So in this case, if you see the loan cost, it was cheaper. So it means in a pandemic, people like who are paying 10% interest per annum, due to emergency situation, bank means RBI announced that no bank will charge interest payment to the customer. So investors no need to pay any interest or on the principal amount during that period, correct? And after that also RBI took decision and reduced interest. So when RBI guys reduce the CRR or SLR, what actually happened here is bank will get more and more money to offer on loan, and then bank, definitely if the bank has a higher supply of money in place, then bank will provide loans in the market at a cheaper rate. And when the loans are cheaper, so more and more people can apply to the loans, take more loans, they can invest more money, and they can multiply asset value. So this is how basically actually things works on the ground. But post pandemic, what happened? RBI felt post pandemic, RBI felt due to huge supply of money in the market, due to huge supply of money in the market, what happened? Post pandemic, what happened? RBI started increasing interest rate, right? RBI has started increasing interest rates, let's say from 9% to even 10, 12. So what it means, if RBI, let's say, increase interest rates, so basically this first condition, like the pre-pandemic rate was this and in a pandemic rate was 9%, so it means this will basically boost like supply of money will increase. Supply of money, and if supply of money increase, guys, automatically loan cost will goes down. So this is simple or basic terminology, you can understand it. If interest rate goes up, then money will goes down, and then simply if interest rate goes up, then sorry, the demand of that money will goes down. People, they'll not look for a loan because the loan cost is very high. All right, that was the case. But in pandemic, what happened, most of the banks, they reduced the interest rate because people were jobless and they're facing some problems, so they felt like bank should not charge any interest payment for that particular period, and bank even waived off the interest rates also. Under the ex gratia scheme, bank announced waiver of interest on different loans. But post pandemic, to just because there was a huge supply of money in the market due to lower interest rates, bank decided to basically increase the interest rates, because is and when the market situation was started improving, at that time the bank decided to RBI decided to basically increase the interest rates from their the previous price to the new highs. And that's how basically, guys, your money market works. Basically RBI control money market, and RBI is the major stakeholder in the money market spectrum, and they take care of everything, the rules, regulations, how we can set up products, how we can sell the products. So everything, like your RBI control it, manage it, and take care of everything. Did you get this? So RBI basically control money market, right? Just answer me in yes or no. Did you get this, guys? Come on, did you get this? Okay, so now let's talk about couple of things, like how SLR work, how CRR work, how does, let's say, your there is something called CRR, SLR, standing rate, right? How standing rate works. So we'll discuss that in details, and again how that actually impact on investments or even money market or stock market or other bond market. So we'll see that in details along with one example. All right. If I talk about, guys, let's say CRR or SLR, and how that works. We'll take a basic example, very basic. So all you can understand it, whether you have from finance background or not, that's absolutely fine. So anyone can understand it if you just try to pay attention here. Let's say there is one investor, right? Let me just draw investor. So this is your investor. This investor want to deposit money with HDFC Bank. right? Okay, HDFC, yeah, HDFC Bank. Let's say how this person want to deposit money. Understand this one. This man is holding 1 lakh rupees, right? And he's saying that want to deposit money with HDFC Bank. If let's say this man you know transfer money to the HDFC Bank, then HDFC Bank receive money here. But HDFC Bank, let's talk about some technical term as well. HDFC Bank maintain two different accounts, right? One is safekeep account, another one is liability account, and third one is, you can say, it's own account, firm account. RBI maintain it. Or there is one more account which you can see. Let me just think for a while. So one more account here would be there, which is investment. Okay. Yeah. So RBI basically maintain all of these accounts. Okay. This is one of the interesting topic to discuss even more details. RBI maintain couple of HDFC Bank maintain couple of accounts, which is your safekeep account, liability account, firm account, and investment account, right? So when let's say this man deposit money with HDFC Bank, that actually money store in safekeep account. Safekeep account, it means client want to let's say deposit money in the client's account only for a safekeep purpose. For example, let's say what happened when when you own open bank account. I'm sure you must have at least thousands rupees or 10,000 rupees in your bank account, right, at the moment, and which is a part of, let's say, your saving accounts. So it means you can spend that money on shopping, grocery, or different things as and when required. Are you getting my point? Am I right? So if you deposit that money, guys, in your normal saving account, that money visible in a safekeep account, right? Because in that case only bank is providing safety and security to your cash, so that you can easily transfer that cash to anyone as and when required. That's the simple logic. Now if I talk about the let's say when investor want to deposit money. So when investor deposit money, so there are ways to deposit money in a different schemes, right? Correct. When investor, let's say, investor deposit money as a FD, means fixed deposit. It could be RD as a recurring deposit, or it could be invest under scheme, certificate of deposit. Correct. These are the schemes. So when investor invest money through FD and RD, so that amount basically, you know, so how it looks like, look at this. It receive bank, it receive bank as a capital, because bank can, then again utilize that amount as a capital, correct? So it means one more account which you can see the bank can prepare it, the possible account, which is, let's say, capital account, where bank refer, that the bank, it's not actual capital account, but bank, if you see how that cash works, you know so, or how that deposit or FDRD amount works, you can just try to understand that, right? So here what happened, so oops, actually the bank receive deposit money from the investor, and that money, credited here somewhere in capital account as deposit money, deposit, or let's say money received under FD scheme, correct? Let's say bank received 1 lakh at, let's say, 5%, return, rate of return, or ROI, rate on investment. So in this case the investment is 10,000, sorry, 1 lakh, and bank has received amount from the investor. See, at that time investor booked this, the amount, transfer amount, as a investment in money market, investment in money market of 100K or 1 lakh rupees. So investor actually book that, investor's book in this way. And also investor book the receivables as well. Receivables, it means every month, the investors receive accrued interest, because the bank has already promised 5% interest payment on 1 lakh amount. Are you getting my point? So bank will pay that every month, the the amount will be credited, or maybe, let's say, processed or accrued on the 1 lakh rupees, the FD which the bank has received from the investor. So now the real game start from here. When the bank, let's say, has received capital, or let's say FD amount as investments, from the investors at 5% interest cost, right? At 5% interest cost. If, again, understand very carefully, guys, if the bank, let's say, if the bank let me just remove this one, I don't want it. Oops. Just a minute, let me remove all of this, because we need a more and more space to draw lots of things. Okay. So when bank, let's say bank received that money as a capital, so what bank, or how bank can manage this money. See, let's assume for a while there is no RBI central bank. Just for a moment, just assume it. There is no central bank or there is no any regulatory. So in that case, what will happen, I'll tell you. When the bank received amount, let's say this amount for 5 years, means for 5 years customer decided to deposit money with the bank at 5% interest rate on FD, fixed deposit. So now the what the bank does in this case, bank will, means HDFC bank will offer this loan to other person, am I right, or needy people who are actually looking for a loan. So now again assume this guy is looking for loan amount of 1 lakh, right? I'm looking for loan amount with, let's say, 12% interest for per annum at per annum for 5 years. All right, this guy is looking for. Now if the bank has capital, guys, if you see, if the bank has a capital, because look at this person invested 1 lakh with the bank at 5% interest rate. All right, so bank has received this and bank is now treating that amount as a capital, because anyways if the bank has received money, so it means bank can manage that money as per the investment schedule or plan, right? So now here the one opportunity, the bank has, like, this person is asking for a loan and with 12% interest for per annum for 5 years, and this particular requirement, it will match with the bank's requirement, because bank is also looking for a same. Basically bank is looking for a difference amount. Difference, it means the bank is looking for someone who is looking for a 1 lakh rupees as a loan amount and can offer more interest rate than the cost of interest rate, because for this 5%, which is a cost for a bank, so bank will have to pay 5% for per annum, it means yearly. So now of course the bank is looking for something which can offer the interest income opportunity, right? Interest income opportunity where bank can earn more interest on the same amount from the other participant. And let's say finally bank has got this person. So now let's calculate that how much the amount bank can make a profit out of it. So again, if the bank, let's say, offer the this FD amount to this guy in the books of, let's say, this guy borrower borrowed money, loan amount, then interest, yearly interest would be somewhere around 12,000 for 5 years. Just calculate 12k into 5 would be somewhere around 60k. So for 5 years, borrower is ready to pay 60k as an interest cost to the bank, and this amount basically received to the bank, right? Received to the bank for 5 years, and bank basically treat this as an investment as well. So bank has an investment investment in loans, amount which is 1 lakh, and income receivable which is somewhere around, let's say, 60,000. So this is what the bank will book it in the bank's book. One side the bank will treat as an investment, so another side again it's a capital as well, where bank has received, and at the time of maturity the bank has received almost 1,60,000 from the investor, from the borrower. Now the same bank has a liability, guys. The liability, it means the deposited money bank treat as a liability as well. Deposited money in FD. How much it was the amount? Come on, 1 lakh. And the return on investment or interest rate or interest cost, how much? Come on, annually 5%. How much? Annually 5%. Annually 5% would be somewhere around 5,000. So 5,000 into 5, because for 5 years, right? The total cost would be 25,000. Total cost would be 25,000. So in this case, the bank has a liability of principal plus interest, which is something 1,25,000, 1,25,000, which is a liability for the bank. On other hand, bank has investment up to which is again the investment amount plus interest, which is equal to, that would be the investment amount, and the bank has, let's say, around 1,60,000, right? So just do the simple calculation, investment minus liabilities. So you can see a difference somewhere around 35,000, and this would be the gross profit for the bank, which is 35,000 per annum. For 5 years, guys. So bank generated profit through difference, because this amount bank received from the investor or borrower, let's say, and this deposited money, it will goes to this investor here, because this investor invested, right? And investor received investment plus accrued interest, basically 25,000. So investor will receive both the amount. So total 1,25,000 amount will receive to the depositor. All right. So this is how simple flow works. So here we haven't discussed the let's say intervention of RBI, anything as such. This was a plain example. Let's say depositor deposited money with HDFC Bank, and HDFC Bank, let's say management, sell it out loans, the same amount, let's say sell it out as a loans to the borrower. Borrower borrowed money for 5 years at a 12% interest rate, and upon maturity borrower returned that fund back to the bank, and then bank, let's say transfer the principal amount, which is 1 lakh plus 5% interest payment, where the bank had committed to the investor, and the same amount, let's say, bank processed to the depositor holder back. And here this particular transaction will close. This was a very simple flow, guys. Very simple. It means very simple. But again, have you understood this? Come on. Have you understood this simple flow? Like depositor bank, borrower. See, bank made a profit through difference between the borrower cost and lender cost, because lender lend money at a different rates and borrower borrowed money at a different rates, and there was an opportunity for a bank to make money out of it. So bank made a profit of 35,000. In this case, now let's try to understand some technical terms, guys. In this case, let's assume it this amount, right, this amount which is 100% amount, correct, this amount which is 100% amount. So same 100% amount, guys, where the HDFC had received 100%. So same 100% amount HDFC has offered to the borrower, right, to the borrower as a advance loan amount, correct? Yes, no, right? See, as it is, see, HDFC Bank received deposit, as it is, HDFC Bank transfer the deposit money to someone else or to the borrower. So this was something like the HDFC Bank utilized 100% amount. HDFC Bank utilized 100% amount, correct? So now, if I put, let's say, RBI rule in this picture, this was a simple picture, but let's assume it, this 100% supply of money is huge in the market, and that supply of money, let's say the people borrowed money a lot, means lots of borrowers participated in the loans, like personal loan, home loan, credit card loan, and they have taken loans from the bank. So now in this case, there is a possibility where the inflation may go up. Inflation may go up. Why? Because as we have discussed, more money available for a bank to borrow, to lend. So it means bank will of course try to transfer all the amount, right? Correct. So basically, bank will try to transfer 100% amounts to the borrower, and bank will try to, let's say, try to make more and more profit out of it. And this is something we can call it as it's a 100% utilization of a fund. But let's say as a RBI, if RBI want to reduce this 1 lakh from the economy, this capital where the HDFC Bank is using, what if, let's say, RBI want to reduce this amount of supply or reduce this amount of money? RBI don't want to, let's say, allow HDFC Bank to do a business with 100k or 1 lakh rupees amount in the market. Then, guys, here you can see the bank will come up with, means RBI, because as a regulator, bank will come up with different rules. Now your question would be, sir, why different rules? See, RBI, which is something, it's a central bank and which control the inflation as well as recession as well. So when we say inflation, inflation is nothing but, inflation means the prices of the product which are high and the common people, they are not able to purchase it. So it means the products which are not affordable. If the products and services, if they are not affordable, so it means it's a possibility that there is a huge money which is available in the market, and that's why people, like more and more people, they have taken loans and spending money on XYZ things, right? They are investing money on XYZ things, and that's when, if you see, the bank will come into picture, like RBI will come into picture, and RBI will come up with certain rules, and that rules you can call it as, let's say, we'll simply discuss again same rule only, how RBI control the supply of money. RBI will come into picture, let's say here RBI and RBI will announce two things. One is CRR, cash reserve ratio. Another one is statutory liquidity ratio. So now your question would be, sir, why this CRR and SLR is important? See, CRR is important because if, let's say, the depositor holder, the money who have deposited, that guy, let's say, needs money in between, so that bank can manage that the that withdrawal part, and that's why CRR which is come into picture. What about statutory liquidity ratio? Statutory liquidity ratio is nothing but, so bank will ask RBI, HDFC Bank, means RBI will ask HDFC Bank to maintain some investments in highly liquid financial instruments. But for what? See, bank will ask to invest some amount of money with RBI or under RBI's the observations. RBI will monitor it. So RBI bank will ask HDFC to invest some amount of money in money market financial instruments under RBI's observation. So what it means, basically, RBI want to protect the investors' money, because if something happened with, let's say, borrower tomorrow, then at least RBI will protect your 10 to 15% amount. Let's say if you deposit 1 lakh with the bank, then at least RBI will ensure that your minimum amount, like 50,000, which are safe. And if something happened to your money, so RBI can arrange the money which is parked in CRR and as well as in SLR account, and repay that money back to you. So that's why both CRR and SLR both are very important to measure. So how it works on the ground, let's discuss that. Right. So RBI asks simply, let's say the current CRR and SLR, it could be different. So we are again discussing hypothetical number. So don't try to relate this with real their numbers. Let's say CRR bank asked to deposit 5%, and SLR, let's say, bank asked again let's say 5% to deposit. So when we say 5%, RBI is asking when the bank, means HDFC Bank, received deposit or FD amount, right? So let's say if the bank, HDFC Bank, has received FD amount of 1 lakh. So out of 1 lakh, so the bank will ask deposit 5,000 in CRR account, and also on 95,000 around 4,500. So bank will again means RBI is asking to the HDFC Bank to deposit around 4,500 deposit in SLR account. So this SLR balance RBI is asking or will ask HDFC Bank to invest in T-bills. T means treasury bills, government bills, then government bonds or forex or liquid assets, right? Or liquid assets, more liquid assets. So this 5,000 money, it will be invested in all of this instruments. And what about this 5,000? This 5,000 guys, it will be parked in this liquid account only or cash account only, and RBI will monitor it, this cash level. Correct. Now the importance of this, if you just observe one thing, so what happened in between guys, so when the RBI is asking to make a provision, for let's say 5% of CRR and 5% of let's say SLR, you can see the net balance which is available for a loan, which would be changed here automatically. So how it will change? So in terms of let's say the capital, how the bank will basically record it. So in this case now the bank has only the 91.5% cash available in the account, and which is something, let's say how much, 91,500, 91,500, correct, because the other remaining amount which is a part of reserve or investment, so reserve amount is 9,500, which is with RBI. So due to this change guys, what will happen, I'll tell you what will happen. Now in this scenario, the HDFC Bank has a limited cash available for a loan business, right? So if let's say now borrower is asking for 1 lakh, but bank cannot offer 1 lakh as a loan to a borrower. Why? Because of CRR and SLR provision. So eventually what will happen, I'll tell you. So here bank maximum amount can offer to the borrower, which is up to 91,500, right? But if the let's say lower amount which is available for a loan business, if the lower amount is available for the business, then bank will increase the rate of interest from 12.5 to 15% for per annum. Why? Because bank don't want to lose interest opportunity on capital, right? Bank don't want to lose this, and that's when if you just calculate it, the interest payment for 5 years, 91,500 into 15 divided by 100, so 13,725 interest would be for per annum. So and 68,650 would be interest rate for but 15% would be again higher interest rate. So you might see slight change in interest rate. Let's say maybe instead of 15, maybe let's say it's a 14% or 13%, let's say. So 1% interest which has been hiked, 91,500 into 13 divided by 100, which is 11,895 interest per month, bank will generate it 895 into 5, which is 59450. So overall interest income which will be impacted due to SLR 11895. So the important here is, guys, if you try to understand the logic, then now there has been change in interest rate, right, due to CRR and SLR. The rate, in interest rate is somewhere around 1%. So again, the personal loans, home loans, or even credit cards will be more pricey, because borrower will have to pay extra 1% interest every year, or even every month as well, right? And even the supply of a money, if you see, supply of a money which has been also, the impacted, which has been reduced by 9500. If RBI want to reduce this again supply more and more, and to ask bank to keep or increase more reserve, bank can impose certain sanctions, or bank can announce, or again, increase in CRR as well. So maybe bank will try to increase, more and more CRR. If bank, let's say, increase CRR from 5% to 5% to, let's say, 5% to, let's say, 10%, 10%, and this is also something somewhere around, let's say, 10%. So total somewhere around 20,000 amount will be in, reserve with the bank. 10,000 here, and maybe 9,000 here, because 10% on 1 lakh, which is 10,000, and 10% on 90,000, which is 9,000. So almost 19,000 amount will be under reserve. So here if you see, total amount would be somewhere around 19,000. So for a loans, the amount will be available only 81,000. So again, the bank may increase this rate of interest, borrowing, rate of interest. Now in this case, the interest rate could be somewhere around 15%. And if we just calculate 81,000 divided by, into 81,000 into 15 divided by 100. So total bank will earn somewhere around, 12,150 divided by into 5. So total the bank annually will earn interest, because the loan amount which is available somewhere around 81,000, but rate of interest which is, more higher, the loan which has been, costly, bank average, the bank will receive the interest amount which is 60,750 from the borrower for 5 years. But now the point is, guys, in the first example, if you see, only there was a 10% interest rate. Then when the CRR changed, then interest rate was somewhere around 12% or 13%. And now again, when the bank announced change in CRR or SLR, the interest rate which has been, changed from 13 to 15%. So basically, in short, if I summarize this, when the bank changes, let's say, CRR or SLR, so it means if the CRR and SLR increases, automatically supply of money, it will reduce. Let me write this. Now we have discussed, but if I write it so you can understand from the investment perspective as well. Note down this, it's a very important one. if CRR and SLR see current level, it could be anything, right? So we are assuming if the bank, let's say CRR and SLR increases from the current level, what will happen? Interest on loans will increase first. Second, supply of money will go down. Third, inflation will be in control, right? So interest on loans will increase. If the interest will increase, then automatically supply of money will go down, because sorry, there is one more thing. When the human psychology is, if the cost of a loan increases, demand of loan will go down, then supply of money, let's say, automatically again goes down. All right, and inflation will be in control automatically. So this is how you can see a flow or linking between when the SLR increases from the current level. Now if you ask me, sir, how we can relate this with the stock market, how we can really see, if CRR and SLR guys increases, if the CRR and SLR increases, so what it means for a stock investor, the meaning would be like the borrowing cost increases, then investor will not invest money in a stock market, because there are investors, trust me, who borrow money from the stock money market at a cheaper rate and invest money in a stock market. And I'm sure you would have seen in the news as well, when RBI announced CRR and SLR, if the CRR or SLR both goes up, then eventually stock market crash or collapse on that particular day, because US market was down couple of days back. Even Indian market was also down couple of days back, because investors were very cautious that what happened if the RBI, let's say, increased interest rates from the current level. If that loans, let's say RBI, if the RBI increase the CRR and SLR from the current rates, so eventually that will impact on supply of money. Automatically supply goes down, demand again goes down, and due to that the cost of loan would be very high. So investors, they cannot afford 15% or 20% the interest cost, and that's when they'll not invest single penny in a stock market. I hope you get this. And what if, let's say, on other hand, what if, now your question would be, what if, sir, RBI, let's say, reduce interest rates, CRR and SLR? If CRR and SLR decreases over the period, then what happened next? So can you guess what happened next if CRR and SLR decreases over the period? Come on, I'll give you 30 seconds to think. What if RBI announce decreases of CRR and SLR over the period? What will happen in that case? I'll give you 30 seconds to think and post your answer in comment box. Come on, guys. Try it. The answer is for you. What will happen if CRR and SLR decreases over the period? What happened next? I would like to see your answers. Loan, okay, loan will more given by bank, interest goes down and demand and supply goes up. Demand for loans go up. Very, very good. You guys which are understanding term. Thank you. Yes. If CRR and SLR decreases over the period from the current level, what happened to the next? Understand this. Loan interest goes down, supply of money goes up, demand of money will increase, and people like more money will be invested in stock or other market, etc. So this is how flow actually works, and that's what people, the investors, like, they eagerly wait if they really, they are like investors, and they just really want to understand how CRR and SLR, the impact on their investment. See, the general tendency is, see, as an investor, if you are, let's say, borrowing money from someone for investment purpose, so you should always calculate the borrowing cost. If the borrowing cost is higher than the return on investments, right, then you should not invest in that assets, and also you should not look for borrowing, the strategy. We have already discussed yesterday, right, about the borrowing, where, when you should borrow, when you should not borrow. We have already discussed, and this is a common or very layman or basic thing, I would say. If the, let's say, interest, cost goes up, why investors will apply for loans? They'll not apply for loans, they'll wait, right? And if, let's say, see, everything which has a pros and cons, and it's a cycle. So RBI will have to monitor the data continuously, like inflation data, then as well as in a recession data, and accordingly RBI will have to manage this entire show. In case of recession, RBI may increase the supply of money. In case of, let's say, inflation, RBI may try to control the supply of money by increasing SLR, CRR. So these are the actually monetary measurement for the bank to control the supply of money. And this actually impact on a stock market, because the more the borrowing cost, less investment into stock market, and cheaper the borrowing cost, then that actually encourage investors to borrow more money from the money market and invest in stock market for more returns. So basically you can see correlation between money market and stock market in this case. Again, this is something which is not like 100% true. It's just the assumption that if the borrowing cost is lower, then the more and more investors, they prefer to borrow money from the money market at a cheaper rate and invest money in a stock market for a higher gain. You get this, guys? Come on. Did you get this or not? What is CRR, what is SLR? Did you get this or not? Yes, no? Come on. I need quick acknowledgement. Have you understood this? Quick, 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 quick. Ask the question, I am here. What do you mean? Ask the question, I am here. Why should I ask question to you? Suraj, we have discussed now how RBI calculate SLR and CRR. We have discussed, right? This example which talks about how RBI calculates CRR and SLR. This is on the basis of there would be a base. Base would be like cost of capital. So bank actually consider the base like the cost of a capital, and on the basis of that, bank try to cover the uh, actually depositors' money through different strategies. All right. Okay. So this was the example of CRR and SLR. So let's discuss some other points as well. So you can see guys, other rates also, because CRR and SLR, these are two one, and which are like very popular one, and which widely impact as well on the market. But apart from that, you may see the another rate also, which is standing rate. Standing rate. Have you understood this, guys, before this? What is standing rate? What is standing rate or standing facility rate? SFR. What is SFR? Standing facility rate. SFR, it means, let's take an example, let's say HDFC Bank is facing some issue in terms of, let's say, liquidity. Then HDFC Bank first can reach out to the other bank for a the liquid let's say call loan. If the HDFC Bank has any issue, then HDFC Bank can reach out to the other bank for a call loan. Could be, let's say, for a bank can reach out to the Axis Bank, or bank can reach out to the ICICI Bank or any other bank for a call loan. Call loan, it means bank will quickly call to the management of, let's say, Axis Bank and ask for help. Hey guys, look, we are looking for 1,000 crores. So can you provide loan facility to us for maybe, let's say, overnight? Because this call loan has a limit. It's a overnight transaction should complete in night only. So maybe, let's say, at 4 p.m. HDFC can ask for a call loan. Means call loan, it means basically bank will call to other bank for a loan amount, and another bank will provide that loan facility to the, let's say, HDFC Bank, and HDFC Bank will provide the rate of interest for that particular night, and bank will just fulfill the obligation, that because see, it is a must to have a liquidity in bank account, no matter what. If it is a day or night, that doesn't matter. At the end, bank should have a minimum liquidity limit which is maintained, and if the liquidity is not maintained, The bank will have to arrange it by hook or by crook. This is something, let's say it's a banking regulatory law. What if, let's say, HDFC Bank reach out to the Axis, ICICI and Kotak? Let's say all bank, they have rejected the proposal of call loan. They said, look, we can't afford 1000 crores at the moment because we don't have a liquidity, and they have denied proposal of HDFC Bank. In that case, HDFC Bank can reach out to the RBI and share the problem with RBI, which is a liquidity problem. In that case, RBI will arrange the money, which is emergency loan facility, and this loan facility will have a interest rate which is a decent interest rate, I would say. And that interest rate, you can call it as a basically standing facility rate. And this rate basically something which would be on, let's say, base rate is 5%, and bank will add margin rate as well, which is a profit kind of, maybe let's say 1%. So SF means, which is facility rate, would be 6%. So here, so what it means, RBI will provide 1000 crores loan facility to the HDFC Bank at a 6% interest rate, and this is what we'll call it as a emergency funding interest rate facility. So in case of emergency, RBI is the bank's bank, or father of all bank, or mother of all bank, I would say. If any, let's say, bank which is in need of funding, then RBI will provide funding through standing facility rate or strategic facility rate also, sometime banks call it to this rate, and that rate would be higher rate than the normal rate. Why? Because 1% would be premium. It means the risk premium. If there is a more risk, then bank will always seek for the more premium on it. So this is how actually it works. क्या सुन रहा हूं मैं? HSBC ने बोनस के दिन ही फाइल कर right? This is how actually it works, and this rate, you can call it as a standing facility rate. Okay, so in short, now if you ask me, sir, what is standing facility rate and why it is important? See, standing facility rate, which is important because if no other bank is helping to the HDFC for a loan facility, in that case, then HDFC can apply for emergency loan facility with RBI, and then RBI charge the 1.5% extra rate than the normal rate on emergency loan amount. So that rate, RBI can call it as a standing facility, or let's say strategic facility interest rate. Did you get this, guys? Come on, yes, no? Did you get this or not? Right? Have you understood standing facility rate? Okay. There are two more rates which are very popular in money market, guys. Let me explain that as well. repo rate and reverse repo rate, repo rate and reverse repo rate. Let me just decode repo, repo or repo. You can pronunciate in both the ways. Re means it's a re actually. Okay, my bad. So re means re, or meaning of this like uh, it could be, let's say, back or again, right? P stands for purchase, O stands for option. So now if I put everything in one line, it looks like repurchase option agreement. Repurchase option agreement, right? Repurchase option agreement. So now how this works, repurchase option agreement, we'll discuss that in details. And if I talk about, let's say, reverse repo, it's just the difference which you can see, like, here it's re means back, and this reverse, it means actually the same contract in opposite direction, right? So basically we are reversing that out. How that works, we'll discuss that in details. Repo rate and reverse repo rate. But in general, if you ask me, sir, how repo rate works, or how, let's say, reverse repo rate works, so let's discuss that through simple example. Let's say here we have HDFC Bank, and let's say here we have RBI, Banks Bank, right? See, RBI, when RBI, let's take example, HDFC Bank is looking for 100 crore, let's say, amount. See, nobody offers amount free of cost to any bank, right? And this amount, let's say, RBI is looking from the HDFC Bank is looking from the RBI, right? HDFC Bank is looking for 100 crores from the RBI bank. In that case, RBI will charge certain amount of rate. RBI will charge certain amount of rate. That rate would be repo rate. So would be somewhere around, let's say, 7% for per annum, or could be 10% for per annum. So on 100 crores, see, RBI will say, or let's say governor of Reserve Bank will say, look, I'll give you 100 crores maybe for 1 year, but we'll charge you 10% rate of return on amount. We are fine. I mean, we are a bank, we have a cash amount, ample cash, cash which is there in the bank account, and we are happy to offer you, but the condition is we'll charge you 10% rate of return on 100 crores loan amount, which is 10 crores. If you are agreed to pay us 10 crore, then we'll give you 100 crores as a loan amount, right? 100 crores as a loan amount. If let's say HDFC Bank management is agreed with this particular contract, right, then we'll call it as, this is a repo rate. So what is happening here? The bank means, the bank is looking for a loan, and HDFC Bank is ready to pay 10%, let's say, the interest cost to the RBI on 100 crores loan amount. So this contract, simply we can call it as a repo rate contract, repo rate. What if, sir, let's say RBI is, let's say, in this case, the another example is RBI is looking for 100 crore amount, loan amount, looking for 100 crore, the loan amount. RBI is looking basically in this case. If the RBI need a fund, and if RBI approached the HDFC Bank for 100 crore loan amount, then again, why HDFC Bank will offer loan to the RBI in free of cost? You tell me. See, in first case we have discussed when HDFC Bank approached to the RBI clearly said that, look, boss, will charge you 10% rate on loan amount. If you are agreed, then only will execute the contract. HDFC was in need, they applied for a loan, and they now paid, let's say, 10% interest, which is 10 crore on 100 crores amount, back to the bank, right? And this contract, let's say, got fulfilled. But in another case, case number 1, this was 1 and this is 2. So in second case, what is happening here? Here the RBI is looking for a loan from the HDFC Bank, and if the RBI is looking for a, let's say, loan from the HDFC Bank, then HDFC can also charge rate of interest on loan amount, correct? Otherwise, why HDFC will offer free of cost loan to the bank, RBI? So in this case, HDFC can also charge maybe somewhere around 8 to 9% basically rate on loan amount, and so that loan amount you can call it as reverse repo rate. Reverse repo rate. So this is how you can differentiate repo rate and reverse repo rate. So understand this flow. In first case, what is happening? In the repo case, RBI is, sorry, my bad. In the first case, HDFC is asking for loan amount of 100 crores to the RBI, and RBI is charging 10% rate of interest on 100 crore amount. So that process we can call it as a repo rate. And in a second example, RBI is asking for 100 crores loan amount to the HDFC Bank, right? And in this case, in second case, HDFC Bank is charging 9% interest rate to the RBI on the loan transaction. So that transaction you can call it as a reverse repo rate. Reverse repo rate. So did you get this? Again, this was a simple thing, but there is a complexity as well. How complexities happened, I'll explain that too. But let me know whether you have understood this or not. Repo rate and reverse repo rate. Come on. Have you understood, guys, this? Come on, come on, come on. Guys, don't mix SLR and repo rate which are different, SLR which are different. Repo rate, which is a tool of credit or loans. If the bank, interbank, let's say, if they are looking for loans from each other, then they use repo rates. So repo rates, it's a tool to raise funds. So there is, you cannot see, it's sometime, it's a habitual, I would say, every time we just look for a comparison. Make sure that you should try to always compare, like apple to apple. Don't try to compare apple to orange. So SLR and repo, why you want to compare, even I don't know, because you cannot compare in that way. You can compare like CRR and SLR, and which we have already discussed. The difference between CRR and SLR is SLR, which is invested in government securities. As I said, you can go back and see the recording. So SLR amount, which will be invested in the government bonds or treasury bills under the RBI's supervision, and CRR, the amount will be still with the bank in a liquid form. Or CRR, sometime again the RBI can take the control, and SLR, which will be invested in a government securities, and RBI will monitor it. But anyways, both the amounts, RBI will track it and force bank to follow that rule. But the repo rate, which is something, it's the rate where if the bank needs funds from the RBI, then RBI will charge that. So it's kind of, it is for a funding basically. If the bank is looking for a loan from the RBI, then RBI is asking for a 10 to 15%, whatever the rate is, the RBI is asking for a interest rate on loan. So you should not compare. Okay. Now my question is to you, Suraj. Let's say you have deposited, in FD around 5 lakhs with IndusInd Bank, and recently what happened with IndusInd Bank is the events trigger and found some irregularities in derivative accounting, right? And you can see the stock of IndusInd Bank price, which has been plugged in the market, the 2000 rupee stock price, which is at 700 or 600 somewhere. Now let's say if something happened with your, let's say if something happened with bank, and now the bank is denying to, repay your money back, which you have deposited, right, which is 5 lakhs, then who will take that responsibility? Then in that case, you cannot go to the RBI governor and look, hey, look, I have invested my 5 lakhs in, the IndusInd Bank, but IndusInd Bank now is denying because they lose money in credit business. Or let's say they had given money to the, the Nirav Modi, and Modi now fled from the country. So now who will take that responsibility? IndusInd Bank. See, IndusInd Bank will say, look, investing in deposit is highly risky. Already we have announced it. Why did you invest? Then who will take the responsibility of your money, and why? My question is to you. Now you will say, look, sir, RBI will take it. Why RBI will take it? Did you invest your money in RBI? No. Then why RBI will take the risk? If you lose money in FD, nobody will take the risk then. So if you want RBI take or should take the, let's say, risk of your money, then you should invest, or a bank should invest money in SLR and CRR. Otherwise what happens, see, it is a common logic. For example, let's say you are earning 50,000. If you receive, let's say, salary in a month, and if you try to spend everything means everything, you received 50,000 and you, let's say, spend 50,000 on your daily needs. What if, let's say, you need an emergency fund for the hospital treatment? So how will you manage it? Come on, answer this question. You have received salary of 50,000, but you spend that 50,000 maybe on a party, shopping and all of this. And let's say in a next week only or immediately now you have some the hospital emergency, and now the doctors or let's say the hospital team is asking for 20,000 rupees immediate payment for XYZ treatment. So how you can manage that? You will borrow from friends and family, then it means you don't have a financial planning in place. So always you will struggle in your life to borrow money, borrow money, borrow money. Then you are not from the finance background. See, ask your mom or ask your sis, they always make a provision for emergency fund. The moms are the best finance minister. They actually save some amount of money every month, because if something happened in family, right, if something happened in family, so that they can utilize that money from the emergency fund. My mom used to save money, emergency fund money, and if you need, let's say, something for a fees or something for clothes or XYZ things, she used to transfer that money to us as and when required. Friends, they are not entitled to pay you money every time. So there is a something called emergency fund which we always maintain. And as a bank, every time you cannot reach out to the RBI, hey RBI, look, I need a funding of 1,000 crores. Even RBI is also not entitled to provide funding to you. So it means RBI will help you to maintain some reserve in a bank when a bank received money from the customer. So if something happened, then the bank can utilize the money from the reserve accounts and manage that emergency situation. That's why CRR and SLR which are required. So CRR money, which is bank will maintain in a cash reserve position. If something happened, let's say if customer withdraw money from the bank, and if something required, so bank can manage everything from the CRR. So every time we cannot touch to the investment, right? If the bank, let's say, given money to someone for 5 years, and let's say now customer is asking money back to the bank, then bank cannot go to that person and ask for, let's say, hey, my customer is asking for money back, can you please give me it to you? Because the bank will sign agreement with the borrower for 5 years. So how then bank will manage the emergency in between? So to manage the emergency in between or withdrawal of funds or any kind of emergency if happened, then bank should have to have SLR and CRR in place. And as I said, CRR, which is a liquid cash, bank will reserve with RBI. SLR, which is a statutory liquidity ratio, it means it's a statutory provision where the bank the RBI will ask bank to invest in a liquid assets like a government securities. Why government securities? Because government securities, which are highly liquid securities, if something happened, so this security can be sell it out in market, and bank will receive money, so that bank can manage that emergency situation. So CRR and SLR both are for emergency fund. Both are for emergency fund. And also, as I said, on other hand, RBI control the supply of money, and we have discussed through examples. In the first example, there was no role of RBI, so there was 100% supply of money in the system, right? And the rate was also cheaper. The more the money, you can see more inflation. And where the bank again decided to come up with CRR and SLR, bank set the CRR and SLR. So you can go and see the example again here, the supply of money which was reduced. If you see, look at this, when the CRR increases, SLR increases, right? And this money, it was with RBI or under supervision of RBI, then the net money which was again available around only 81,000 for investment purpose. And the bank also offer um HDFC Bank only offer 81,000 for a borrowing purpose, because this 90,000 fund, which is something maintained for a emergency activities. If borrow, let's say depositor asks for a withdrawal, or you know any kind of reversal or payments, so bank can manage that everything or all the request from the reserve balance only. So this is how, guys, things works. It is a very simple that to say, no, no, I'll ask for a friends to pay. Trust me, if you are in a need, nobody even pick your calls. So if you are a finance professional, then right from the beginning, make sure that you have a provision in place for emergency fund. I have seen, many times. I was, admitted in hospital in 2014. It was very, early time of my career. I was admitted in hospital. When I contacted to my parents, see, they were in a hometown, but they said, very next day they'll deposit money in my account, because my parents, they are like farmer, means they're farmers, so they hadn't like banking facility and all. So meanwhile, what I did, I reached out to the couple of friends. Hey guys, I just need money for, just this overnight. I'll pay you back once my dad deposit money in my bank account. Just give me money because I'm admitted in hospital. Couple of friends, they just said, okay, I'll see, I'll try to give it to you, but at the end, nobody in a transfer single penny. And this was just one incident, but there are hundreds of stories which I have seen in my life. So don't rely on friends. Don't rely on it, because your friends also, see, they are also maybe, rely on their parents' pocket. If they have, they'll give it to you, but if they don't have, then they'll not, because they don't have a capacity at all to pay you money at the moment. And there would be some friends, they don't entertain to such, activities. If you ask for money, they'll simply say, no boss, I can't. So the good thing is, learn the very important lesson from the bank is, so always you should have to have, uh, you should have to have money in your account, right? You should have to have it. Okay. So I hope, I'm assuming that you would have understood this repo rate, reverse repo rate, then all other, the things. Now let me just decode the investment accounts, firm accounts, and liability accounts. See, SAFE account, it means simply whatever, the saving accounts or current accounts we have. So bank treat them as a, the accounts which is created for a safekeep purpose, right? And bank maintain it. Now, if I talk about liability, firm, and investment account, in case of liability account, anything, let's say bank raised funds through deposit or FD or RD, so bank treat that, amount as a liability only. So for example, let's say depositor deposit money in RD or FD, so bank treat that amount as a liability for the bank and maintain as a liability. So maybe, so you can understand in that way or this way, let's say, if you deposit money in RD or FD, means fixed deposit or recurring deposit with the bank, so that amount bank treat as a liability for the bank, right? But same, the RD or FD, it can be investment for you. That's how you can understand it. Now if I talk about firm account which is created for own investment. So bank can also, do some their own investments from their pockets as well. For example, let's say bank invested 1,000 crores in government securities, right? And it is their own investment, so bank maintain that, right? So this is how actually things works. Okay. So it could be any investment. Then if I talk about firm investment, it means it could be any investment. The bank if the bank has, that investment, so bank maintain as a separate investments from the deposits or current accounts or saving accounts, because this is something required for a regulatory reporting as well. A bank cannot say, look, I have received thousands of crores and now I'm treating them as my own money. No, bank cannot say this. If the money received in saving account, it should be treated, that money as a safe keep money. If the money received in FD or RD, that money bank can treat as a liability, because it's a liability for the bank. And if bank has any, their own investments, it could be in, let's say, buildings, furnitures, technology, or it could be anywhere, right? So that amount or that investments bank can treat as a firm's investments or firm's account. And if I talk about, let's say, investments, if the bank, let's say, has offered, any loans to anyone, it could be home loans, personal loans, or vehicle loans, or any loans. So that loans, basically, it's a investment for the bank. So bank maintain that under investment. So this is how you can see the bank maintain separate or different accounts to track the investments or liabilities or safekeep funds separately. All right. So let me know if you have any confusion in between. Quick. Any confusion? No confusion, guys? All good? Okay. Now, if I talk about the T-bills, the government securities, the T-bills, which are very critical instruments, I would say, because RBI, manage that treasury bills. T-bills, it means it's a treasury bills. T-bills, treasury bills, and this comes under money market. But who issue these T-bills and how it works? First, let me discuss that background as well. Let's say the let's talk about telephone ministry. Telephone ministry is who is the telephone minister? Telecommunication minister. Who is the Scindia? Okay. Let's say this guy is looking for 100 crore money, right? 100 crore money for short expenses, very short expenses. Who is looking for? Telecom minister. Right. So in that case, what happened? Telecom minister table that bill in the parliament, right? Now this bill, it could be, let's say, it's a tender of 100 crores for maybe renovation of BSNL office or expansion, or it could be anything, right? So expenses are expenses anyways. So it could be miscellaneous expenses also. But the telecom minister is looking for, let's say, 100 crore short in expenses or small expenses bill. So that bill, minister will, table that bill in the parliament. There would be debate around it, and then the speaker, speaker of parliament now, send that bill the president of India, and this bill it will be approved, right? This bill it will be approved. After that, what happened? Then the telecom minister sent the bill to the finance ministry, right? Then your finance minister will come into picture, Nirmala Sitharaman. Let's say finance minister has looked into their accounts and she felt, okay, this is a very small bill, and now, at the moment we cannot manage the funds from their current account, the 100 crores, let's say they are not able to manage it. Then simply FM will ask, or FM means finance minister will call to the RBI, not exactly call to the RBI, there of course there would be certain process, but I'm just, giving you very high level, what happened exactly with the bills. Then FM, will call to the RBI and ask RBI to, manage the 100 crore funding, maybe for, let's say, 90 days. It's just a short term funding, right? And within a, let's say, 90 days, then telecom minister will arrange the funding and, return back that funding to the finance ministry, and then finance ministry maybe, can arrange the, liquidation of, let's say, the bills and everything. After all, it's a bills. When we say T bills, it means treasury bills. Treasury, it means finance. All right. Bills, it means invoice of contract. All right. Then after, maybe, when guys again understand this, if the 100 crore, let's say, bill issue in the market, T bill issue in the market, then nobody purchase, it looks like this 100 crore bill, and it will mature in 90 days. GOV India, it looks like this. So this is your bill, and this bill will expire or mature in 90 days. Then nobody purchase this bill at 100 crore. Why? Because if someone is, let's say, purchasing this bill at 100 crore, then what would be the benefit of that person then? Let's say same example applies to you as well. If I ask you, hey, can you give me, I have a bill with the worth of rupees 100 crore, let's say, can you give me 100 crores for 90 days? Then your next question would be, okay, I'll give it to you, but what would be my benefit? Why should I give you 100 crores? Tell me my benefit, I'll give it 100 crores. That would be your question basically. You get it, my point? That would be your question, man. And then here you can see one thing, which is, then RBI will do some framework. RBI will say, look, the face value of a bill is 100 crore, but will issue this bill issue price of this bill is 99 crore. So it means you can buy this bill at the moment at 99 crore, but at the time of maturity, right, same bill you can sell it to the means RBI or bank at 100 crores. So there will be a profit of 1 crore, right? So that 1 crore you can, treat as an income on this bill. And if let's say RBI is agreed with this, RBI said, okay man, that's fine, we are fine with, we'll purchase the bill at a 90 crore, and after 90 days same bill will sell you at 100 crore, correct? So that you can give us a 100 crore back, so my profit would be somewhere around 1 crore in this transaction, and I'm happy to give you 99 crores to you. So this is how, guys, actually T-bill works. But if you try to understand now the one thing, here you can link your repos. Repos. Repo, it means repurchase option agreement, right? T-bills exactly works like repo rates. In a repo rates, what the banks they're doing, one bank is committing, one bank is asking for a loan, other bank is charging for interest rates, right? But same bank, let's say, if asking for a loans, then again another bank which is charging interest rate, right? In T bills, what is happening then? So just simply, if you see the technical way, or just try to, if you design the chart, government has bill of 100 cr, RBI is intermediate person, and HDFC Bank. See, HDFC Bank is the buyer at 99 crore for 90 days, right? And RBI is the seller on behalf of government, basically. Seller of T-bill at 99 crore with face value of 100 cr, right, for 90 days. 90 days. So it means understand this, on execution of this contract, on let's say in a execution or initiation of the contract, what is happening here? What is happening here? The RBI is selling bill, right, to whom? HDFC Bank, and HDFC Bank is buying bills at 99 crore for a 90 days. But there will be a clause. It's a repo clause. So what it means? The repo clause is something RBI will commit. RBI will buy back bills from the HDFC Bank on or before the 90 days of completion, and paid 100 crore, right? So at the time of settlement, now if we just try to again understand this, on settlement date, so what happened? RBI purchase bills back at 100 crore from HDFC, and in the books of HDFC, how it looks? HDFC sell the purchase bills at 100 crore to the RBI. This is something, it's exactly, this is the example of repo rate, guys. This is the example of repo rate, right? And this is again another example of reverse repo rate. Why reverse? Because in a reverse repo rate, what happened? The bank want to take the back, reverse, or reverse the securities, or take back or repurchase the securities from the buyer. So bank want to buy it back security from the main, the buyer of the securities. In simple word, if you ask me, this is something, this repo, it looks like buyback of own shares from the buyer at a higher price, right? Means buy back the own shares from the buyer at a higher price, right? But now, why, sir? Your question would be, why then RBI is selling? Because they need a funding, guys. They are selling bills to the HDFC. It means they are looking for a 99 crore fund at the moment. So when RBI sell the bills to the HDFC, then HDFC will give 99 crores funds to the RBI for usage, right? And upon maturity, RBI will purchase the own bill back from the HDFC bank and return the 100 crores which was committed. Correct? So this is how actually repo and reverse repo works. So in a T-bill, your repo and reverse repo actually works. Okay? So now your question would be, sir, can you just tell us a little bit more feature about it? T-bills has a settlement cycle, trading cycle, guys, like 91 days, 182 days, then something around 364 days. These are the types of T-bills. So minimum duration would be 91 days, maximum duration would be 364 days, and T-bill, which is a highly liquid assets or asset class in the money market space, right? Banks invest for a quick return. Even mutual funds also invest for a quick return. Investors also, invest for a quick return. PF fund and insurance companies also, invest in T-bills for a quick return. In terms of risk, I would say zero risk or no risk, because after all we are investing money in government securities. In terms of liquidity, very high liquidity. Very high means very high liquidity. And in terms of return, you may expect low return on investment, because you are giving money to the government. It means government can't offer higher return on investment. No, government just need a funding from you for a short term, things, or day to day, let's say, the expenses. That's what government is looking for, money from you. So that doesn't mean government will offer any higher interest rates to you. No. See, in a finance, there is a rule which is like risk and reward rule. More risk, more profit. Low risk, low profit. So in the T-bills, you can see very low, risk. You cannot expect higher profit then. Okay. So any question, guys, with the T-bill? Come on. Benefit of buying T-bills is, so don't you see a benefit here? 1 crore profit, right? So you are buying at 99 crore and selling at 100 crore. So it means there would be a benefit of 1 crore, correct? So basically the government's guys offer bills on discount. 100 rupees bills, government will, offer on 90 rupees. So 10 rupees will be your profit. So on maturity date, government will process the 10 rupees benefits to you. And that would be your profit basically. And it's a very quick, profit process. So most of the mutual funds and, PF funds or insurance companies as well, basically the government instruments, which are very good instruments in terms of provident funds or the retirement planning as well, because at the age of 60, 70, that doesn't make any sense if you just multiply your assets in crores, right? Because at then it's a end period on this planet, you're going to die, then you don't require crores of rupees in your pocket. So you need a crores of rupees at a very young age. Let's say let's say you are in 30 or maybe 20, 25, right? You need crores of rupees in your bank account, maybe to to live your life like king size. But at the age of 90, at the age of let's say 75, 80, you don't require the huge return from the investments. Then what you required protection to your money, so at least you can fulfill your needs, because at the age of 70 or 80 you won't be able to do anything, right? So you can't work, you can't do anything. So at that age you will require the consistent return on your investment. So what you can do at the age of let's say 80 or 90, you can ask financial advisors to invest your money in a government securities where risk could be very low. Even if you let's say invest 2 crores in government securities, you can earn minimum of 14 lakhs for per annum, and I think which is enough for your medical bills or standard of living at the age of 70 or 80. Are you getting my point? But still, if you have let's say more than 1 crores in your pocket, you can look for a fixed income opportunities, because stock market is highly volatile and you may lose money. But in a government securities, you will not lose single penny. So still you can earn around 10 lakhs for every years on 1 crore value, without doing anything. Just simply put money in the government securities and sit relax. You get it, guys? See, same example to explain in detail like this would be difficult. So I would request you, if you are not able to understand some portions, so just highlight that to me. I'll explain that part. If you are, and even audience will get bored as well to just brief everything as it is. So tell me which portion you haven't understood. T bills is just a bill, man. Finance ministry or any ministry, if they need a funds, they just go to the parliament, submit the bills, and then parliament send that bills to the president. President approve it. So same bills they just go to the finance ministry and ask for the payment. So at that time there are two options: finance ministry will disburse the funds, then no T bills will be active in the market, or otherwise finance ministry will ask the reserve bank to help ministers to raise funds. So in that case, the RBI will issue the bills in the market on discount. So it's a simple process. And same bills you can see corporate companies also issue the same bills. If you are let's say businessman, understand T bills in a simple way. Let's say you are a businessman and you have traded amount with a trader with let's say 1 crore. So you have traded with 1 crore, and let's say you are a sailor in this case, okay? You sold goods, but now buyer is asking you to wait for for this consideration, wait for a month, or let's say wait for 90 days. So waiting period of this contract is 90 days. And let's say, but you are looking for the immediate fund. You have sold the goods, you are looking for funds, but your party is asking you to wait for a 90 days. What will you do in this case? you have a traded amount, let's say xyz goods you have sold to the buyer purchase it, but now buyer is asking you to wait for a 90 days for a payment. So it means there is a waiting period of 90 days. There is a waiting period of 90 days. Then how you can manage this situation? And let's say this 1 crore is highly, let's say, urgent for you. Maybe another party is asking for a payment. Let's say you had purchased raw material from the party, let's say party B, which has sold goods to you or raw materials of 50 lakhs, and now you are looking for immediately this amount. See, the here the point is you are not in a position to wait, right? You are not in a position to wait for 90 days because this party is looking for a 50 lakhs immediately. The reason is you purchased raw material from the party B, produce some product and sell it out to the buyer, but buyer is asking for a 90 days holding period. So now you tell me how you can deal with situation as a businessman. Guess, I'll give you 30 seconds to everyone to think on it, how you can resolve this situation. Come on. Come on. How you can resolve this situation? Let me see your responses. Short, I ask money from someone, nobody will give it to this. So don't tell me this again and again. I'll ask some money from friends. See, in a finance, there is no friends. So no one offer money even free of cost. So don't apply your generic logic here. In a finance, guys, see, always we ask for a credit, or maybe always we ask for a short term funding on some obligations, maybe interest rates and all of that, right? So now if you ask me, sir, how you can manage this, so what I'll do, see, when you sign the when you sell the goods, guys, so you can see there will be a invoice, right? Correct? Which is bill of exchange, right? Bill of exchange, it means the bill of the contract, which talk about, let's say, the goods value, let's say 1 crore. So this bill actually, I'll simply go to the bank, let's say HDFC Bank. HDFC Bank. I'll ask HDFC Bank to provide me loan, right? Loan against bill of exchange, right? I'll ask HDFC to provide me loan against bill of exchange. Then HDFC Bank will ask for documents. Hey, where is the contract document? Then I'll submit bill of exchange, which is the agreement between buyer and seller, correct? Buyer and seller. So this agreement I will submit with HDFC Bank. HDFC will do the thorough review of this contract, and if HDFC Bank feel that okay, this could be potential investment opportunity for a bank to make money, then bank will come up with solution. Look, You have, the bill with worth of rupees 1 crore, correct? Bank will say, for the next 90 days, what I will do means, bank will say, I'll give you 1 crore, you know just deposit bill. Bank will say, deposit bills, sign obligation. So bank will disburse 1 crore to you immediately. Bank will disburse this 1 crore, but bank will actually disburse you not exactly 1 crores, could be, let's say, somewhere around uh, 90 lakhs. Bank will disburse you 90 lakhs. See, actual the worth of bill is 1 crore, but the bank is only agreed to pay 10 lakhs, sorry, 90 lakhs. Then what about 10 lakhs? So 10 lakhs bank will actually, ask for a discount on bills. And this discount on bills, which is something income for the bank. That's what I said. In a finance, nobody works in free of cost. So don't tell me this, I'll ask for a friend, I'll ask for a friend. Why someone will? Is it someone really free for you to do, arrange this money for you? No. Then don't tell me this, someone will arrange funding for you. No. Okay. So basically, you can reach out to the bank will arrange funding for you, which is 90 lakhs. And then, this, out of this 90 lakhs, you can settle this, the party's payment as well. And you can keep 40 lakhs with you, which is your profit. But in this transaction, definitely you can see a loss of 10 lakhs, because if you wait for, let's say, 90 days, you may get, the entire amount, which is 1 crore. But due to time and, your obligations, then you can really think about, your other obligations. And, quickly you can, look for a funds with the bank and deposit your money. Then after 90 days, what will happen? See, after 90 days, what will happen? The seller will send the instructions to the buyer, stating that, look, you don't need to pay money to me, you can simply pay money to the, HDFC Bank only, because actually I'm a payable of HDFC Bank, so you can pay HDFC Bank directly. So buyer will pay 1 crore to HDFC Bank. Again, through this transaction, if you just actually calculate the profit of HDFC Bank, which is at 10 lakhs, see, the bank by bill amount is 90 lakhs, right? And bank will sell the bills at 1 crore. So just calculate the profit for the bank. So net profit is 10 lakhs. So this is how bills actually works, guys. So same bill, now just replace the, instead of, let's say, private parties, say it, this is a seller is government, and instead of this, let's say, it's a bank. So initially bank will purchase bill at, on discount, and at the time of maturity, same bill, the government will repurchase from the bank at agreed price or at original price. So that's what I said, the bills actually issued on discount. Right, 99.99% cases T-bills which is actually issued on discount and redeem at full face value. For example, let's say actual treasury bills value is 100 rupees, then issue price should be 90, and at the time of maturity buyer will receive 100 rupees. So this is how basically your T-bills works. So this bill of exchange would be in corporate companies or private companies, and T bills would be in governments. The transaction, if any ministries of government needs funding, short term fundings, so they basically raise fundings through bill of exchange. So Finance Ministry of India basically organize that or arrange the funding facility to the ministries with the help of RBI, because RBI is just the banking partner for Finance Ministry of India. Still, if you have question, I'll explain it. Suraj will sell the contract and buy it back up to yes. See, at the initiation of the contract, the companies or seller basically sell the bills, and at the time of maturity they just buy it back same bills, means liquidate the bills and pay the agreed amount. So this is a very basic term. You are selling the bills at let's say XYZ amounts, and same bills you are buying back at maturity from the same party at a higher rate. Simple. And why we are doing this? Just because of funding only. So you can raise funding quick, if you just offer discount, you can raise funding. This was all about money market. So if you have any questions, so please go ahead, ask me questions, whatever questions you have. Try this link. I have shared this link as well. Refresh it out. Maybe you can revisit to this session again.